I time traveled to the past to find out where the price of Bitcoin will move in September. The years were 1981, 2000, 2008, and 2019, years that shook the world and left lasting scars. What if I told you that hidden in the events of these years lies the key to unlocking Bitcoin's fate this September? Picture it, a time when Indiana Jones battled ancient relics. Y2K sent shivers down every corporate spine. Iron Man soared into the skies, and Game of Thrones burned kingdoms to the ground. Yet none of those epic moments matter here. I'm talking about something even more epic. The Fed interest rate cuts. What they decide next could change the future of your crypto portfolio. Spoiler alert, it's probably not what you think. Let's get it. I'm not a financial advisor. Welcome to the channel. I'm your host, The Bit Boy. If you want to learn more about crypto, make sure to hit that subscribe button. If you find value in this video, make sure to hit the like button. I think you're going to. Stick around until the very end of this video. Also, if you want to find out where I think Bitcoin will move with September's rate cuts, or just wake me up when September ends. The Fed began aggressively raising interest rates in March 2022 to combat inflation, marking the start of the current rate hiking cycle. Over the course of 2022 and into 2023, the Fed raised rates multiple times, bringing the federal funds rate to its highest level in decades. As of mid-2024, the Fed had paused further rate hikes, but has not yet cut rates.
The anticipation is electrifying, with markets seemingly waiting on the edge of their seats for the prophesized moment where Jerome Powell walks across that stage to his podium and declares those magic words, "The Federal Reserve is cutting interest rates."
Odds are favoring a 25 basis point cut this month. The question is, how should we expect the markets to react? First, let's go back in time and look at the way risk-on markets were affected when the Fed pivoted to cut rates. Bitcoin has only existed for one of these pivots, so I'll have to use the S&P 500 for the closest case study. But don't worry, I'll get to Bitcoin too. In 1981, after aggressively raising rates to combat inflation, the Fed began cutting rates. Initially, there was a sharp decline in the stock market as high rates caused a recession. However, as rates were cut further, the market rebounded strongly, leading to the bull market of the 1980s. Now, how about Y2K? The Fed had raised rates throughout the late 1990s to cool down the dot-com bubble. In 2000, the Fed pivoted and began to cut rates due to the looming recession. The market continued to decline after the first few cuts, as the tech bubble was still unwinding. It would take several years for the market to recover. The S&P, well, it saw a sharp decline of nearly 50% from 2000 to 2002 before the market eventually rebounded. Then there's the global financial crisis of 2008. After a period of rate hikes, the Fed began cutting rates aggressively to combat the housing market collapse and the ensuing financial crisis. The stock market experienced significant losses, even after rate cuts. The S&P 500 plummeted, losing nearly 50% of its value. At the time, many thought it was game over. But those who held their nerve saw the market soar back in 2009. So what have we learned so far? Rate cuts were supposed to be the hopium the bulls have been waiting for. But according to history, it seems like Fed pivots toward rate cuts are actually bearish. This is only half the story though. Rate pivots in 1980, 1984, 1989, and 2019 could actually be seen as bullish. Within 6 months of the first rate cut, these pivots resulted in anywhere from 10 to 26% returns on the S&P 500 for an average of a 14.64% gain. That's like a 1,478,000% gain in crypto. Am I right? What's more is that although the market slumped a little immediately after each pivot, it took anywhere from 5 to 20 days for the index to reach its local bottom. That makes for an average of 11 days from rate cut to price bottom. Let's zoom in on 2019. Well, after a series of rate hikes following the Great Recession, the Fed reversed course, cutting rates in response to concerns about global economic growth and trade tensions. Initially, the stock market reacted positively to the rate cuts, as it helped extend the bull market that started in 2009. However, the COVID-19 pandemic in early 2020 caused a sharp crash. The S&P 500 performed well after the pivot, rallying from $3,016 on July 31st, 2019 to $3,380 on February 19th, 2020 for roughly a 13% gain. That's a face-melting rip for stocks. But we're not just here to talk about stocks. Let's bring it back to what really matters for crypto investors. Bitcoin. History doesn't just repeat itself, it rhymes. Bitcoin is volatile and tightly correlated to its halving cycle. Immediately after the rate cut in 2019, Bitcoin went on to rally almost 30% from $9,592 to $12,325 in just 7 days. Now, there was still some bear market left to go as the halving wouldn't come until May of 2020. So Bitcoin would go on to retrace all of those gains, going even lower to the $6,000 level. Infamously, during the short-lived March COVID crash, it would drop in half to the $3,000 level. The lesson here is the adage that investors see every past bear market as opportunity. in every price dip in the market as the end of the world. So what do we learn? Well, rate cuts are typically bullish for risk on assets, but the market's immediate reaction depends on the broader economic environment and investor sentiment. The major difference always boils down to this. What are the prospects of a looming recession? Whenever the Fed has cut rates ahead of a following recession, the S&P 500 would suffer, not because of rate cuts, but because of the recession they were trying to combat. Whenever there's a soft landing or a positive economic outlook, the market reacts bullishly to the first rate cut. After all, rate cuts mean debt is cheaper and investors' pockets are fuller. Maintaining a soft landing can also mean turning the money printer back on. At the end of the day, those in control will move the sentiment in the direction they want the price to go. When Jerome Powell speaks, whether he's dovish or hawkish, will show where the puppet masters want to move the market. Personally, I expect a bullish reaction to the rate cuts given a soft landing is projected for the economy. But remember, for the S&P 500, that has always meant anywhere from 5 to 20 days of decline, followed by bullish recovery. This could set us up for a bearish September, maybe somewhere in the $47,000 to $52,000 level, followed by a green October to kick off a bullish Q4. What do you think? If you want to stay one step ahead of the market as the Fed plays its hand, drop your thoughts in the comments down below, smash that like button, and make sure to subscribe if you found value in this video. That's all I got. Be blessed.